Hey, welcome back. Today we're talking about what to check before dealing with a bank on any real estate purchase. Because the truth is, lenders work off internal rules most buyers never see, and those rules can shape your entire financial future. Most folks walk into a bank thinking they're in the driver's seat, when in reality, they're not. After more than a decade in finance and real estate investing, I've learned the most expensive mistakes are the quiet ones. The assumptions you never questioned, the fees you didn't see coming, the clauses buried in page 17. So in this chapter, I'll walk you through the exact factors I personally review before agreeing to any mortgage offer. Grab a pen and take notes. Here's what I check before ever putting a dollar into this. Let me start with something most people overlook entirely: how banks actually see you on paper. I always begin by understanding how a lender will categorize me internally, because everything flows from that initial assessment. The rate you're offered, the approval amount, the conditions attached, all of it depends on whether the bank labels you as low, medium, or high risk, and that classification happens long before you sit down with a loan officer. Banks use a combination of factors to determine your risk profile: credit history, repayment behavior, income stability, outstanding debts, and even your employment type. According to most central bank guidelines, this assessment is largely automated these days. Algorithms scan your financial footprint and assign you a tier. Even a missed payment from 2 years ago can affect where you land, depending on the lender's sensitivity settings. Different institutions weight these factors differently, which is why you might get approved at one bank and rejected at another for seemingly no reason. So here's what I do first. I check my credit report thoroughly, not just the score, but the actual report. I look for recent credit inquiries, confirm that no small forgotten debts remain active, and verify that my repayment history is clean. Most credit bureaus provide free annual reports, and it takes maybe 20 minutes to review. But that 20 minutes can tell you exactly how the bank will see you before you even apply. I've caught errors on credit reports more times than I can count. Old accounts that should have been closed, payments marked late that were actually on time, inquiries from lenders I never contacted. When you know how the bank sees you, you can predict their offer before they give it. You're no longer guessing. You're operating from information. And that changes the entire dynamic of the conversation. Good investors treat this step as part of the bigger picture. It's not paranoia, it's preparation. If you find issues on your report, you can dispute them before applying for a mortgage. That simple action can shift you from medium risk to low risk, which translates to better rates and higher approval amounts. I also look at my credit utilization ratio, how much of my available credit I'm actually using. Banks prefer to see this below 30%. If you're maxing out credit cards, even if you pay them off every month, it signals potential stress. So before applying for a mortgage, I make sure my credit cards show low balances. It's a small adjustment that can have outsized impact on how lenders perceive your financial health. Now, once you understand your risk profile, the next thing to verify is your real borrowing power. And I want to be clear about this. Your actual budget isn't defined by what you think you can afford. It's shaped by formulas banks use to protect themselves. Most lenders rely on variance of debt service ratios, which typically limit your housing costs to around 25 to 35% of your gross income, depending on region and bank policy. You can verify this yourself using public mortgage calculators or by reviewing lender guidelines directly. When I work with clients, I ask them to calculate both the bank's maximum exposure and their personal comfort level. Those numbers are rarely the same. The bank might approve you for $500,000, but your real comfort zone might be $350,000, or vice versa. Either way, you need to know both figures before you start shopping for properties. I've seen too many buyers get approved for an amount they can technically afford on paper, but that leaves them stressed every month. They're house rich but cash poor. They can't travel, can't invest elsewhere, can't handle an unexpected repair without scrambling. That's not wealth, that's a trap. So I always recommend running your own numbers first. Look at your monthly income, subtract your fixed costs, factor in savings goals, emergency funds, and retirement contributions, and see what's actually left for housing. Then compare that to what the bank offers. The gap between what the bank will lend and what you should borrow is often significant. Banks calculate maximum lending capacity based on risk management, not your life quality. They want to know you can make payments. They don't care if making those payments means you're living paycheck to paycheck. That's your problem, not theirs. So you have to be the one who draws a realistic line. This step is a grounding exercise. When you know your real ceiling, your decisions become clearer and more rational. You're not chasing the biggest loan you can get. You're choosing the loan that fits your life. And that distinction matters more than most people realize until they're already locked into an uncomfortable payment schedule. From here, one factor affects borrowing power more than almost anything else: your debt-to-income ratio. Most people underestimate how sharply lenders respond to even small monthly payments. One car loan, one gadget on installment, one forgotten subscription service, these things add up fast, and they reduce your approval limit by tens of thousands, depending on the bank. According to many financial regulators, a healthy debt-to-income ratio sits below 40%, though each lender interprets it differently. Some are stricter, especially in volatile markets. Others are more flexible if you have strong credit or stable income, but the principle is universal. The more monthly obligations you carry, the less room the bank gives you for a mortgage. They're looking at your total debt load and asking whether you can handle one more significant payment on top of everything else. You can verify this easily. Add up your recurring monthly debts, car payments, student loans, credit card minimums, personal loans, anything that shows up as a fixed obligation. Then divide that total by your gross monthly income. The result is your debt-to-income ratio. It's a simple calculation, but it's the check most buyers skip, and it costs them leverage. I've worked with clients who could have qualified for significantly higher loan amounts if they just paid off one small debt beforehand. A $5,000 car loan might not seem like much, but if it's costing you $300 a month, that $300 affects your borrowing power across the entire mortgage term. Sometimes the smartest move is to clear small debts before you even approach the bank. Yes, it delays your application by a few months, but those months can translate to tens of thousands in additional borrowing capacity. This step teaches a simple principle: the cleaner your financial footprint, the more flexible the bank becomes. They see you as lower risk, and that opens doors. It's worth taking the time to tidy up your financial profile before you apply. Pay down credit cards, close unused accounts, settle any outstanding collections. These actions signal responsibility, and banks reward responsibility with better terms. Now that we've covered borrowing power, let's talk about how banks determine the rate itself. Most buyers believe their interest rate is based solely on credit score, but that's only one part. Banks also consider market liquidity, central bank policy rates, and their own internal lending targets. If liquidity is tight, meaning banks have less cash to lend, rates rise. If banks need to hit quarterly lending volumes, rates can soften slightly. It's all connected to the larger financial ecosystem. I verify this by monitoring central bank announcements, scanning for lender promotions, and comparing rates across multiple institutions. Based on my experience, the differences may be small, often fractions of a percent, but over a 20 or 30-year term, those fractions add up. A rate difference of just 0.25% on a $400,000 loan can mean tens of thousands in interest over the life of the mortgage, so I always recommend checking rates at multiple points. Don't just accept the first offer. Call 3 or 4 lenders, check online platforms, and note the range. Then ask each lender directly, what factors are driving this rate right now? Some will be transparent, others won't, but the act of asking signals that you're informed, and that alone can improve your offer. I also pay attention to economic indicators, inflation reports, employment data, central bank meetings. These events often precede rate changes. If the central bank is signaling rate hikes, I know mortgage rates will likely follow within weeks or months. If they're holding steady or cutting rates, that creates opportunity. Understanding these patterns helps you time your application more strategically. This step reminds us that timing matters. Mortgage rates are part of a larger financial ecosystem. If you can wait a few months for rates to shift, sometimes that patience pays off. Other times, locking in quickly is the right move. It depends on the cycle, the market, and your own situation. But you can't make that call without information. Rate timing isn't about predicting the future perfectly. It's about positioning yourself intelligently based on available data. Next, let's shift from rates to the actual loan products banks offer. And here's something I always tell investors: You're not choosing a bank, you're choosing a structure. Fixed versus variable, long-term versus short-term, amortizing versus interest only. Each product changes your total cost and your risk exposure. Fixed rate loans give you stability. Your payment stays the same for the entire term, which makes budgeting easier and protects you if rates rise. Variable rate loans often start lower, but they fluctuate with market conditions. If rates drop, you benefit. If they rise, your payment increases. It's a trade-off between certainty and flexibility. You can verify the real difference by running side-by-side comparisons using amortization calculators or by reviewing lender brochures carefully. A rate that looks lower up front may end up costing more, depending on the payment structure and term length. I've seen variable loans that saved borrowers money in the short term but cost them significantly more over 15 years because rates climbed steadily. The point is simple. Good investing isn't about chasing the lowest headline rate. It's about choosing the structure that matches your income stability and long-term plans. If your income is steady and predictable, a fixed rate might give you peace of mind. If you're expecting income growth or plan to refinance in a few years, a variable rate might make sense. But you need to understand the trade-offs. I usually ask clients a few questions before recommending a structure. How stable is your income? How long do you plan to hold the property? How much risk can you tolerate in your monthly budget? How sensitive are you to payment fluctuations? The answers guide the choice. There's no universal best option, only the best option for your situation. I've also seen hybrid products that start fixed for a certain period, then switch to variable. These can work well if you plan to sell or refinance before the variable period kicks in, but they require careful planning and honest assessment of your timeline. If your plans change and you end up holding the property longer than expected, you might find yourself stuck with unfavorable terms. But even the right structure can turn costly if you ignore the fine print. Banks often include conditions that can quietly increase the total cost of your loan. Appraisal fees, processing charges, insurance requirements, lock-in penalties, and early repayment clauses. These aren't illegal, they're just rarely discussed up front. The loan officer might mention them briefly, but unless you're paying close attention, they slip past unnoticed. I verify this by requesting the full fee sheet from every lender I consider. Most banks provide a key facts document or a loan estimate form that breaks down all costs. I review it line by line. I ask the loan officer to confirm every conditional fee. What happens if I repay early? What if I miss a payment? What are the administrative costs? Are there annual fees? What about valuation fees, legal fees, or title insurance? Based on what most analysts see, hidden costs can add an extra 1 to 3% to the total loan amount over time depending on the lender. That might not sound like much, but on a $400,000 loan, 3% is $12,000. That's real money, and it's avoidable if you catch it early. I've also seen clauses that penalize borrowers for paying off the loan ahead of schedule. The bank wants you locked in for the full term because that's how they maximize interest. So if you plan to sell the property or refinance in a few years, you need to know whether that flexibility is built into your agreement or whether it'll cost you. Some early repayment penalties are calculated as a percentage of the remaining balance. Others are flat fees. Either way, they can significantly impact your financial flexibility. This step reinforces a guiding principle. Details matter. A mortgage is a long agreement, often spanning decades. Small fees compound. Conditions that seem minor today can become obstacles years from now. Read everything. Ask questions. Don't sign until you understand the full picture. And if something doesn't make sense, ask the lender to explain it in plain language until it does. Next, we need to look at how the bank evaluates you, specifically your job and income stability. Banks prefer consistency. If you've recently changed jobs, switched industries, or moved from employment to freelancing, lenders may classify you as higher risk. Most institutions want at least 6 to 12 months of steady income, though this varies by lender and loan size. I verify this by reviewing my employment contract, checking payslip patterns, and preparing supporting documents. If I'm self-employed, I gather tax returns, bank statements, and client contracts that demonstrate consistent revenue. If I've switched jobs recently, I explain the context clearly and provide proof of the new role's stability. an employment letter, a contract showing permanent status, evidence of probation period completion. When I guide new investors, I always recommend they stabilize their income profile before applying. Even waiting a few months can improve approval odds. The reason is simple. Lenders value predictability. They want to see that you can make payments consistently over 20 or 30 years. If your income is erratic or your employment history is spotty, they see risk. And risk translates to higher rates or lower approval amounts. I've worked with freelancers and entrepreneurs who had strong income but struggled to get approved because their earnings fluctuated month to month. In those cases, we focused on building a paper trail, consistent deposits, long-term client relationships, diversified income streams, business registration documents. Over time, that documentation convinced lenders that the income was reliable even if it wasn't coming from a traditional employer. For self-employed borrowers, banks often require 2 years of tax returns showing stable or growing income. They want proof that your business isn't a flash in the pan. They'll scrutinize expenses, profit margins, and cash flow. So if you're planning to apply for a mortgage and you're self-employed, start organizing your financial records well in advance. Clean books make the process significantly smoother. This step shows that lenders value predictability. The more stable your profile looks on paper, the smoother the process becomes. It's not about having the highest income, it's about having provable, consistent income that the bank can verify and trust. Now let's turn to something most buyers overlook entirely: how banks judge the property itself. Banks don't lend based on emotion, they lend based on resale risk. Factors include property age, building quality, location, market demand, and even nearby infrastructure. Older properties or high-risk zones often trigger lower appraisal values, which reduces the loan amount the bank will approve. You can verify this by reviewing comparable sales in the area, checking public records, or studying municipal development plans. According to many valuation firms, even a location shift of a few streets can impact lending confidence. A property in a well-maintained neighborhood with strong schools and public transport will appraise higher than an identical property in a declining area. Banks look at historical price trends, vacancy rates, and demographic shifts. They're asking, if we have to foreclose on this property, can we sell it quickly? I always research the property's lending profile before making an offer. I look at recent sales data, check for planned infrastructure projects, and review the building's maintenance history if it's part of a complex. If the property has structural issues, is in a flood zone, or sits in an area with high crime rates, the bank will factor that into their risk assessment. Sometimes that means requiring a larger down payment. Other times, it means rejecting the loan entirely. I've seen deals fall apart because the property didn't meet lending standards even though the buyer was well qualified. The building was too old, the area was considered too risky, the property needed repairs that made it ineligible for standard financing. These issues aren't always obvious until you're deep into the process, which is why early research matters. This step highlights a core idea. Banks aren't just financing you, they're financing the asset. If the property fails their tests, your approval can shrink or disappear. So before you fall in love with a property, make sure it meets the bank's standards, otherwise, you're wasting time and effort on a deal that won't close. With the property covered, let's talk about your down payment strategy. Down payment requirements shift with the market cycle. When credit is loose, meaning banks are eager to lend, they allow lower down payments, sometimes as low as 5 or 10%. When conditions tighten, minimum requirements rise, often to 20 or 30%, depending on the region and property type. I verify this by checking central bank bulletins, watching lender announcements, and reviewing market news. I've seen periods where banks quietly increased required equity because they expected market cooling ahead. They wanted more skin in the game from borrowers to reduce their own exposure. In uncertain markets, banks become more conservative. They want to know that if property values drop, they're still protected. The lesson here is simple: flexibility matters. The more equity you bring to the table, the more negotiating power you hold. A larger down payment reduces the bank's risk, which can translate to better rates, fewer fees, and more favorable terms. It also lowers your monthly payment and reduces the total interest you'll pay over the life of the loan. In some cases, hitting certain down payment thresholds eliminates the need for mortgage insurance, which can save hundreds per month. I usually recommend saving more than the minimum required down payment if possible. Yes, it delays your purchase, but it also strengthens your position. Banks respect borrowers who demonstrate financial discipline, and if the market shifts while you're saving, you might find better opportunities or more favorable lending conditions. This step ties back to patience. Real estate is a long-term game. Rushing in with minimal equity might get you into a property faster, but it can also lock you into unfavorable terms. Taking the time to build a stronger down payment often pays off in ways that aren't immediately obvious. Lower monthly stress, better loan terms, increased negotiating power. Finally, let's finish with the part most buyers misunderstand: negotiating with the bank. A lot of people think negotiating a mortgage is like haggling at a market. It's not. Talking to lenders isn't about being aggressive, it's about being prepared. When you understand your risk profile, your borrowing power, and the exact terms you're willing to accept, negotiating becomes straightforward. Banks respect informed borrowers because they're easier to process. You're not wasting time with unrealistic demands. You're not confused about the terms. You know what you qualify for, you know what you want, and you're clear about what's negotiable. That clarity speeds up the process and often leads to better outcomes. I verify my leverage by comparing offers from multiple lenders, reviewing competing products, and asking directly which conditions are flexible. Some fees are fixed, others aren't. Some rates are non-negotiable, others have room to move, but you won't know unless you ask. From my experience, even a small adjustment, like removing a processing fee or improving the loan term slightly, can save money over time. I've negotiated mortgage terms dozens of times, and the pattern is always the same. Lenders appreciate borrowers who've done their homework. They're more willing to work with you if they see you're serious, informed, and financially stable. On the other hand, if you walk in unprepared, asking vague questions and making unrealistic demands, they'll give you the standard offer and move on. So before you approach a bank, do the work. Check your credit, calculate your debt-to-income ratio, compare loan structures, review the property's profile, and know your budget inside and out. Prepare a simple summary document showing your financial position, your target property, and the terms you're seeking. This demonstrates professionalism and signals that you're a serious borrower worth investing time in. Then, when you sit down with the lender, you're not asking for favors. You're discussing terms from a position of clarity. You can reference competing offers. You can point to your strong financial profile. You can ask specific questions about fee structures and rate adjustments. This approach doesn't guarantee you'll get everything you want, but it significantly improves your odds. This step ties everything together. Informed investors negotiate from a position of clarity, not emotion. They don't panic when a rate is slightly higher than expected. They don't accept terms blindly because they're eager to close. They take their time, verify the details, and make decisions based on facts. So here's the broader picture. Every step we've covered, from understanding how banks see risk, to calculating your borrowing power, to negotiating terms, is part of a single process. It's about approaching real estate finance with the same discipline you'd apply to any major investment. You wouldn't buy stocks without researching the company. You wouldn't start a business without a plan, and you shouldn't take on a mortgage without understanding every factor that shapes the deal. The strongest portfolios aren't built in excitement, they're built in confirmation. Every number you verify, every clause you read, every question you ask, these are the quiet actions that protect your wealth over decades. Real estate is patient, markets cycle, rates shift, but the discipline of verification remains constant. When you slow down and check the details, you're not overthinking, you're thinking correctly. And that difference over time is everything.